Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your September 2020 market update. I wanted to start out by showing you a chart of the S&P 500 index, which is a measure of the performance of the largest publicly traded companies in the United States. The green lines here indicate advances or declines of at least 5%. And last month, my commentary focused on the strong market performance we had during the month of August. We ended August on a high note, as shown on this chart. And if you watched the video, you may recall that I said that the market looked overbought and was ripe for a pullback or at least a pause that refreshes. And that is what we had during the month of September. At its lowest point during the month, the S&P 500 was down 10%. However, it rallied back to end the month down only 3.8%, but still posted its first negative month since March. The good news is that the month-end rally came on the heels of better than expected economic data. ADP's monthly private sector jobs count showed growth of 749,000 in September, ahead of the 600,000 expected. Meanwhile, pending home sales soared 8.8% in August, marking its highest pace on record as 30-year mortgage rates dropped to 3%. And while COVID showed no signs of stopping, positive news on the vaccine front helped pacify many investors. For the third quarter of 2020, domestic large cap stocks returned almost 9%. Small caps were up almost 5%. International and emerging markets also posted positive returns of 5.81% and 8.36% respectively. Commodities rallied 9.07%. And on the fixed income side, domestic investment grade bonds had muted returns of 0.62%, while riskier segments of the bond market, such as high yield and emerging market bonds, outperformed. Moving on to the economy, this chart shows every recession in the United States since the Great Depression. And the size of the circle indicates the extent of the decline in economic activity, and the duration of the decline is on the y-axis. And you can see on the far right-hand side of this page that we are still in a recession, and that the current recession is one of the deepest recessions we've had since World War II, with a 10.2% decline in real GDP. How long we will be in a recessionary environment is not yet known, but many of our clients have been wondering, if we are in one of the deepest recessions we've had since World War II, why has the stock market rebounded so much this year? And I want to take some time to address that today. While every recession is different in terms of its cause, this one is unique in that it was triggered by a health crisis. Additionally, it is also unique in the terms of the extent of the monetary policy response. What do I mean by that? Well, when a nation's economy slides into a recession, the Federal Reserve uses monetary policy tools to reduce interest rates, and this has a ripple effect throughout the broader economy. Monetary policy refers to the actions the Federal Reserve takes to influence the nation's money supply, as well as the overall economy. And when I say money supply, it means just what the term suggests. It's the total amount of money available within an economy for spending. And in order to keep the money supply in check, the Federal Reserve can do a few different things. They can buy or sell treasuries. They can set the interest rate that banks pay for overnight loans from the Federal Reserve. And they can tell banks what percentage of bank deposits they must keep on hand instead of lending out. And by using this tool, the Federal Reserve tries to ensure that the nation's money supply doesn't grow too quickly, which will cause excessive inflation, or too slowly, which would hamper economic growth. So now that you know a little background about monetary policy, how is it contributing to the stock market this year? Well, when we're in a recession, as we are now, the Fed uses these tools to lower interest rates. And the lower the interest rate, the more willing people are to borrow money and to make big purchases, such as houses or cars. When consumers pay less in interest, this gives them more money to spend, which can create a ripple effect of increased spending throughout the economy. And businesses also benefit from lower interest rates, as it encourages them to make large equipment purchases due to the low cost of borrowing. This creates a situation where output and productivity increase. Now remember that the stock market moves based off of future expectations. So when interest rates are low and are expected to remain low, as is the case now, the assumption is that consumers and businesses will increase spending and investment. And because of this, the potential for future earnings increases. Remember that whenever you invest in the stock market, you're essentially buying a stream of future earnings. So this is a good thing for investors. Additionally, low interest rates decrease the interest rate on bonds, money markets, and certificates of deposit, making them less desirable for investors to hold. Investors typically want to invest in asset classes that give them a higher potential return, so the low potential return for some parts of the bond market is beneficial for the stock market. And combined, this has a powerful effect. Low interest rates tend to lead to an increase in the stock market due to the potential for higher future earnings and more demand for stocks over bonds. And during this recession, the Federal Reserve has indicated that it'll keep interest rates near historic lows for the foreseeable future and has used its monetary policy tools in an unprecedented way in order to shore up the economy. And additionally, Congress has enacted widespread fiscal policy and is discussing another stimulus package. These actions have put somewhat of a floor under the equity market and have led to the substantial rebound that we've seen since the lows of March earlier this year. So year to date, our portfolios have performed well relative to blended benchmarks and similar strategies, but on an absolute basis, globally diversified portfolios have fairly low returns so far this year. This is a chart of the returns for major asset classes over the last few calendar years, and it shows the best performing asset class in the top row and the worst performing asset class for each year in the bottom row. In year to date, a moderate globally diversified portfolio has earned about negative 0.3% before fees. So this has been a difficult year in terms of earning a decent return. However, this is not out of the ordinary. What I wanted to show you is the returns of the S&P 500 going back to 1926. Now, we run portfolios that are much more diversified than this. We're not investing just in the S&P 500, but I think it illustrates the point well, in that since 1926, the average annual return of the S&P 500 has been 10.2%. While we quote 10.2% as the average return, this does not mean that an aggressive investor earns 10.2% per year. Investing works over time, not all the time. In the last 94 years, the S&P 500 has returned between 8 and 12%, so near that 10% target, in only 6 calendar years, which is the blue column on this chart. And it's gained more than 20% in 35 calendar years, and it's lost more than 20% in 6 calendar years. So overall, if you're looking at the S&P 500 over the last 94 years, 73% of the time it generates positive returns, 27% of the time it generates negative returns. And when you annualize this out over time, aggressive investors can earn a return of about 10.2% historically. So I just wanted to encourage you that despite low absolute returns generated so far in 2020, keep your focus on the long-term and steady plotting, because that's really when the math works in your favor. Finally, I want to look ahead to the election because I know it's on a lot of investors' minds. We do expect volatility to continue over the next few weeks, given the contentious election that is on the horizon. And around elections, investors tend to get either overly optimistic or pessimistic. I keenly remember in the lead up to the 2016 election, in the sense of real fear for many people that if their candidate didn't win, the market was going to collapse. But here we are 4 years later, and we're still standing. Fears surrounding both parties tend to be overblown, and in the months following an election, the market tends to look fairly similar regardless of which party takes control of the White House, the Senate, or the House of Representatives. So just keep that in mind as we approach November. From what we know of the policies so far, the main differences between a Trump or Biden presidency centers around taxes, fiscal policy, regulation, and China. Under Trump, the corporate tax rate dropped from 35% to 21% during his first term, and if re-elected, federal tax policy will remain unchanged, and a tough stance on China and tariffs will likely be maintained. Biden's plan calls for raising corporate tax rates from 21% to 28% and raising individual tax rates on those who make more than $400,000 per year. The hike in corporate taxes would have an impact of reducing corporate earnings per share by around 4 to 13%, which has worried some investors. However, the plan has been widely telegraphed by Biden, so it's possible that some of that potential tax hike, if he were to win the election, has already been priced into the market. The prospect of larger fiscal stimulus, as well as more predictability in trade policy that would come from a Biden victory, would likely be viewed positively by the markets as well. So as you can see here, in terms of Trump and Biden, there are things that the market may like and things that the market may dislike for both of them. And we'll just have to see how the policies and how the election itself plays out over the next few weeks here. As always, we continue to watch the global economy and the election closely, and we will make changes to the portfolios as warranted. Thank you for your continued confidence, and please reach out to us with any questions that you may have.